And to respond to the response, the piece I just said about the Can-Am, we are deeply saddened that the Can-Am is not going this year. It's been a very strange year for us in northern Maine. We don't have a lot of snow. We're not hearing the snowmobilers up here, a few of the diehards, but it was a little bit surreal yesterday when they were taking the Can-Am signs down off the posts. And I think we'll lose all our snow with this rain. I've got about a foot of snow on the front lawn, and I'm sure it'll be gone by the next 3 or 4 days. So, but hey, there's always next year, right?
Absolutely, it'll be a Wallapalooza.
And actually, the reality is we're not going to be skipped over. We're going to get a real nice big 2-foot storm like on March 15 or something like that. It always happens. They never miss us. So. It looks like everybody's here this morning. Welcome. I'd like to call the investment committee meeting to order, and I'd like to ask the clerk of the board, Beth, to take a roll call of the meeting.
Good morning. Trustee Martin?
Here.
Trustee Moore?
Here.
Trustee McMahon?
Here.
Trustee Riley?
Here.
That's all that we have for the committee members.
And we also have
And
non-voting.
do we have, how about the non-voting? I believe we have Matt Scaves is with us today.
Yes.
Oh, and Jim just joined us. Hey, Jim.
Hello,
Matt.
Kelly.
We're all using umbrellas today, huh? All over the state. So I just want to remind everybody, and I'm going to try to figure out what my mute button is here too, that while you're not talking, if you could just leave your mics muted when you're not speaking. And now we'll just go on to the first item on the agenda. I believe we're going to pass the meeting over to Mike, either Mike or Barry from Cap Trust. You're going to go, Barry?
Yep.
So we'll go ahead and introduce the first item on our agenda today, the defined contribution plans quarterly review. So without further ado, you got the floor, Barry.
Yep. So Mike, you're going to share your screen. I think it's raining on the East Coast. Here in Richmond, Virginia, it's also raining. So it's a little warmer though. You know, one of the things that we talked about and we implemented over the last couple of years is when a participant is terminated and they have a balance below $5,000, we have the ability to pay out those balances either in the form of rolling it over to another humane plan that has more than $5,000, rolling it to the new employer's 401k plan, 403b plan, etc. But in the absence of any sort of action, we automatically roll that balance over to an IRA that we have established with Millennium Trust, which is now Inspira. The reason we do that is there is a fixed cost to maintain a record on a record-keeping platform. And so the higher the average account balance, the more leverage we have to look at fees. And so it's really good practice to eliminate some of these smaller balances, which are a drain really on the overall efficiency of the plan. Congress has allowed this since 2001. In 2004, they established some safe harbor provisions to go along with this. We've done this a couple times. I think we started in 2020, and we did that more recently in the last fall. One of the provisions of Secure Act 2.0 was to increase the amount from $5,000 to $7,000. Again, you know, these smaller balance participant balances are a drag on the overall efficiency of the plan. So this is really the action item that we have on page 98. So I was going to take care of this now, Trustee Martin, if you don't mind, but we think it's good practice to do this. We did do some revisions to the letter. It's going to be more clear what their options are in terms of if they have another UMaine plan, because it's by plan, that they have over $7,000, they have the ability to roll that money over into another plan to avoid this outside organization to house the IRA product. But ultimately, we want the trustees. We are at least recommending the trustees approve the increase from 5,000 to 7,000.
Madam Chair, can I ask a
Do you have any
question?
Yeah, sure. Go ahead, Ryan.
Yeah, I recall maybe it was a couple of years ago. I think the unions brought this up, and I don't know if it was, I don't know if they just didn't understand it, but we heard some concerns about this. Haven't heard much since then, so maybe it was just maybe they just figured it out and that it made sense. But is there any kind of education phase that goes along with this? What's the communication with our with our members or former employees on this? So I just remember I can't remember if it was at a board meeting or somewhere, this issue popped up and we had to run it down, and that's why it's all familiar to me. But just wondering, if we can if the board can expect pushback on this.
Yeah, I would just add that Professor McClymer is the one who brought it up and appeared before the board to complain about it. So I think you're spot on, Ryan.
So the first thing is a required disclosure. So we would send a letter out. I think it's probably 30, 45 days in advance. I think it's maybe 45 in UMaine's case. And we lay out the option. So option A is you have the ability to roll over to a UMaine plan if it's applicable and it's above this threshold. If they have a new employer, they can roll the money over to the new employer's plan. It's really the default. Like if they take no action, then the default is to roll it outside to an outside IRA. The IRA, we have selected Millennium Trust, who is a partnership with TIAA, and they have the ability, once they establish the account, to go invest in other mutual funds. So they do have flexibility. And if they ever want to roll that money out, it's not a static decision. So if they want to roll the money out a year from now, which is now called Inspira, they can do that. And so they have a direct relationship with them. So we're disclosing it. We did there was some complaints. We recognized there were some complaints, I think, in the fall. And so we revised the letter to be crystal clear, like what their options are, especially as it relates to other UMaine plans that they might have the ability to roll this money into.
Can I follow up? Because I well remember that hoorah, and it wasn't just Mr. McClymer, it was retirees from USM and others, and they had three concerns. One was the quality of the organization itself that was being rolled over. They said it didn't, as I recall, there were concerns it didn't meet, I don't know, better business standards or something. There were concerns about the entity it rolled to. And I think there were concerns about the timing. Did they have enough time? Notification. And I totally appreciate the importance of doing this. But I think how we do it, Ryan's right, is important. And so how much time, when I find out about this as a retiree, how much time do I have to make the decision and make a rollover decision? A, and B, what do we know about this? If I don't do that and it's an automatic rollover, what do we know about the entity?
And I seem to recall as well, there were some issues with at least there were some concerns on the organization itself. I think we addressed those concerns at that time. So if we need to resurrect them, we certainly can. But the minimum is 30 days. We can do it, upwards of 60 days. I think probably 45 days is really a sweet spot in terms of giving them an ample time once they get the letter to make an informed decision. But we can give it as much as 60 days from the time that we send the letters out.
Given the hoorah lesson, that might be a good idea.
Okay, all right.
Could I add
Tracy?
yeah, thank you. A couple of things. I really appreciate the question because I also heard the concern around this, and yes, we've gone through the letter extensively making a clearer, working with CapTrust and TIA, what all of the options are, extending the time. Beyond that, the HR leadership, CapTrust, Mike Pratico, myself, met with Jim McClymer to talk about this and other concerns that he had and walk through the detail extensively. And a lot of the edits came out of that conversation. And Mike has also offered to meet with him and other participants to discuss these and other concerns that were raised. Additionally, the individuals that these disbursements are made to are terminated participants, not current retirees with very low balances, and but full well recognize that a lot of the points that Jim raised, we weren't aware of. So it gave us an opportunity to expand that communication, and it was our intent to address every concern that he raised. So I hope we've done that. And with regard to the millennial and that has changed names, we did do some due diligence around that. That was a while ago when that was first raised. And that was a company that TIA does a lot of business with. And it really wasn't about necessarily the business, but a lot of the communications that I think we've addressed.
Okay, thanks, Tracy.
Dan Malloy again. Can I just suggest that somebody reach out to him in the meantime, and if this action is to be taken, and open up a dialogue?
I would be happy to do that.
Great, thank you.
I appreciate all the contribution on this, and thankful for the transparency, because when we take care of this stuff up front, we have less of an issue. Now, Chancellor, are you suggesting that, and this is a question for you and also for Tracy, where did you leave it with Jim? Has he seen the final piece? Are we all set to move forward on this today as an action item? And Chancellor, what's your suggestion?
Well, it seems to me it seems to me that this is the appropriate thing to do, but I don't think we should. I think we should take a moment and reach out to him, sit down with him, explain it. Seems to me would be the better way to head off misunderstanding, and rather than have him hear about it because somebody else got a notice.
One point of clarification is what we're asking the trustees to vote on is the increase to the 7,000. If we want to delay when we do it, we can do it at any point in time in the future. We just have the ability to increase it to 7,000. And so if those are caveats to a formal acceptance of the recommendation, we're certainly comfortable with that. We don't have to do it at any point in time. It just gives us the ability to do it when it's appropriate to do it.
Could I ask, have you run how many more accounts will fall under the 7,000 as opposed to the 5?
We haven't.
Could you?
We could, yeah, we don't have it today, but yes, we could.
Okay, so I think that's the kind of information that we should get ahead of and share with him. He was the most vocal of the organized folks, so I think we should absolutely do that.
Okay, so with all that being said, I'm looking at the text of the proposed resolution, and it is just to move it up to 7,000. We feel that we should move ahead with that today, and as far as implementation, or I get a no from Trustee Riley. Oh, Trustee Moore, I just see your hand up there. Sorry.
Yeah, I think
right ahead.
I think maybe wait till they've been notified. It makes sense. Why open a hornet's nest if you're not sure? Get ahead of it, like they're saying, and wait. I think this does bring to a larger issue when you're looking at efficiencies, some of the other procedures that could be looked at, maybe not necessarily by this committee, but by FFT or some of the other committees. The one that's come up to me for efficiencies is the capital project over 50,000. I'd love to look at that at some point and see that increase where we're trying to increase our efficiencies. Again, this probably is not the committee, but I think looking at ways to be more efficient, especially with different costs going up everywhere, would be a great idea.
Kelly,
you.
I wonder if we might table this if there's no urgency from Jim's perspective until the next meeting? Or we could pass
So-
it with caveat pending discussions.
If you don't mind, I'd like to go back to Tracy's resources. We already have the $5,000 balance, small balance in place right now, correct, Tracy? So
Yeah.
it would actually be, if we were, I think if we were voting on small balance to begin with, I think that would be an issue. I think increasing the balance doesn't really hurt anybody in that regard. So I don't know. We want to just get feedback on that. So it's already there. The small balance rule is already there. It's just increasing the balance. So if people don't have to leave the plan, they have $2,000 more. They can have $2,000 more before being asked to.
Yeah, I think that's a good point. I think the issue that Chancellor raises is significant, though. We need to know how many people given that it was controversial before, and there's no problem from Jim's perspective with holding it off. We probably should know how many people and get some outreach going before even this, to avoid any kind of confusion and miscommunication.
Okay. So just for proper order, how do we, actually, we're not even on, we are talking about tab 2. We aren't there on the agenda right now. How do we remove this from the agenda? Do we take a motion to remove that, to table it?
We could do, yeah, I think we can definitely do that.
Yeah, and Trustee Martin, why don't we just bring it back to the next committee meeting, and take no action on it today, and then we can provide an update after having reached out to Mr. McClymer. I believe the last time we made distributions were August, so we're not set to do that for a while. We do have some flexibility around that. And then that way the committee can feel more comfortable with the conversations, and we could have it as an action item then.
Okay. And I just want to correct what I said. I was a little bit backwards in what I was saying. It would actually involve more people on this. So let's get the numbers and let's bring it back. Our next meeting is when is it in the end of May?
Yeah.
Yeah.
Okay.
Okay. So just for order as well, do we want to address this right now and make the motion, or do we want to just move to tab 1, do the review, the quarterly review, and then come back and make a motion to push this off to the next meeting with work being done on count as far as how many people this would affect, and making sure that we talk to the people that this affects.
I don't believe an action is needed. The minutes should reflect this conversation, and we just pull it and bring it back. It's not, I don't think action to pull a resolution from my experience.
Right. Thank you. So without further ado, we will move ahead with the continued transparency, talk to the stakeholders, get a list of everyone that the increase in the small balance payout will affect, the number. And without further ado, is there anybody that has any other any more they'd like to add to this while we're still on this? Hearing none, then I will pass the baton back to Mike and Barry for the quarterly review on the defined contribution plans.
So thank you. Very good discussion. One of the things we do at the beginning of each year is really just look at, like, what are some trends that we're seeing in the marketplace that could come to fruition in 2024. So this is not all these things will come true, but at the same time, we're seeing, various trends in the marketplace. So if I start at the left, if financial wellness continues to be a really hot topic, Universities are spending more resources in terms of overall wellness, financial wellness, making sure that individual faculty and staff members are prepared either for retirement in this case, budgeting, all those sorts of things. And so we see that as accelerating, not decelerating in the future. We're also seeing retirement income. The good news with TIAA, you have a built-in retirement income vehicle. TIAA does a really good job of promoting TI traditional. And so when people get ready to retire, they have the ability to monetize that in the form of annuity. In the middle column, Secure 2.0 continues. There's a lot of optional provisions out there. There are some provisions that many plan sponsors are kind of just a wait and see, like some of those federal disaster relief, having access, greater access to the funds when it is a federal disaster. That could be an option we would want to explore. Just getting more ability for people to gain access to these funds throughout their career in terms of life events that might take place. Cybersecurity continues to be on the forefront. We've seen, TIA does a really good job of looking and promoting, what they're doing in terms of cybersecurity. They have a lot of different protocols in place. In fact, at the participant level, they have 100% guarantee if an individual account gets hacked for any reason, not of their own volition, TIA has a guarantee to give that money back to them, so they would be paid back in full. So, but with it, it's certainly a big thing. I think it's obviously with the university as well. Protecting plan and participant level information will continue to be at the forefront, we think, in the years to come. A new fiduciary rule took a comment period that came out at the October 31st, Halloween, and primarily it's focused, and I'll talk about this here in the next page, on one-time events. So if somebody leaves the University of Maine on the left-hand side here, they might have a balance to roll over. In the past, there was a 5-part test, and part of it was a regular basis that they would review the plan. And so a lot of these brokers out there got around kind of this 5-part test with a one-time recommendation, so they didn't have to do it in the best interest. So we're proponents of this fiduciary rule. Any interaction you have, especially with distributions, we think is a fiduciary interaction. And so it'll be interesting to see if this, I think this is a second or third time around, if the actual will come to fruition in terms of law of the land on the fiduciary rule. Go back one page, Mike. You just on the right-hand side, we're seeing more fervor taking place with respect to small balance distributions. We had a really robust discussion just a moment ago. There is now a consortium that TIA is part of, TIA, Fidelity, Vanguard, Empower, Principal, etc., that they're in the makings of a consortium. So if somebody leaves the University of Maine system for one reason or another, and they go to a new employer that might have Fidelity as a record keeper, in the future, when this takes place, ultimately that balance will go from the University of Maine plan to the new employer's plan automatically through a clearinghouse. So that's more to come on that one. There's a lot of moving parts on that, but we do see that as a benefit, because if you think about the transient nature of your employee base, what do they typically have? 5, 7, 8 jobs over their career, and they can never accumulate a meaningful retirement in any one location. So this is a way to consolidate assets as they move along their career path. And last but not least, the CITs, the collective investment trusts, we are hopeful that passes sometime in 2024. That will allow us to look at the fund menu and offer lower versions of the same options that we have available in the plan today. So we are anxiously awaiting that's passage. Unlike most things in Congress, it has bipartisan support. And this is just further notes on the cybersecurity. One of the things we are seeing plan sponsors looking at is just doing a re-review of your record keeping agreements to make sure cybersecurity is part of the record keeping agreement. Yeah, I'm tracing because it's been fairly new. I'm thinking that it is, but I think it's probably good practice for us to take a step back and look at the record keeping agreement itself to make sure they have the various protocols and provisions within the record keeping agreement. And this is just really it's I think we all recognize this when we're in an inflationary environment and people are having to spend more money on groceries, more money on gas. We have seen a rise in withdrawals, hardship withdrawals across three of the record keepers, Empower, Fidelity, and Vanguard. And so it's just a recognition that in an inflationary environment, it's eating away at retirement, but at the same time, they have to, put food on the table. And so making sure we have the options within the plan that allow for these types of things, which we do, even when they retire, having things like installment options, so they don't have to pull all the money out at one time, which we do as well. But it's just an acknowledging of kind of where we are in the marketplace today in terms of a tightening of the home budget for sure has caused some consternation across the nation for sure. Any questions on the topicals before I turn over to Mike to talk about the markets and the funds? All right, Mike.
Great. Well, thank you, Barry, and good morning, everyone. I'm going to just shut my video off. I'm kind of having some quirky things with my system, like Kelly had mentioned as well for some reason. So I think it runs a little bit better with my video off, but hopefully you can still see the screen okay. I'm going to take you through just a brief market update as of year end, and obviously I'll also provide some more recent data as well, as we now are towards the end of February, almost into March. But really from a market perspective and from a plan perspective as well, it's all good news to share here today. You can see based on the chart in front of us, 2023 was indeed a really strong year in the markets. Really, in many ways, just the opposite of a year ago when we were talking about full year 2022. And the full year 2022, we were talking about all equity asset classes being down and fixed income being down as well, as a result of largely the rising interest rate environment. About the only place to make money in the markets in 2022 would have been commodities, and that was largely energy, the result of energy prices going up. Well, all of a sudden you fast forward a year and you can see just a completely different picture here. In many ways, this chart looks a lot like what we were looking at back in 2019. US large cap stocks, that's over on the right-hand side of the screen. The Standard & Poor's 500 index was closed up 26% for the year. So truly an outstanding year for domestic equity. That, I will say, that number can be a little bit misleading because that is a very, very highly concentrated to a relatively small number of funds, and certainly just a couple of sectors. I think everyone's probably heard the phrase Magnificent Seven. That's the 7 stocks that have really been driving the market. It's the Facebook, Apple, Amazon, Netflix, Google, Nvidia, which is all of a sudden just become one of the largest companies in the nation. Tesla kind of in and out of that Magnificent Seven. So we used to call it the FANG stocks, and now we're calling it the Magnificent Seven. That may evolve to something different. Hopefully it'll evolve to something which includes a lot more stocks, because frankly, if you were to remove just those 7 stocks from that number, we still would have been positive with the S&P 500 for the year, but we would have been talking about single-digit positive numbers instead of 26% returns. It was also a really good year in international equities. So the EFI benchmark that we look at here was up 19%. Following a strong fourth quarter. And then maybe the best news of all, if we jump over a couple columns, as you can see in the bond space, the aggregate bond index closed up 5.5% for the year, following a real spike in the fourth quarter. And again, that I think has probably been the most difficult part of the market over the last couple of years for investors. I think equity investors are used to market volatility and used to periodically seeing losses on their statement. Bond investors, frankly, I don't think a lot of bond investors, frankly, I don't think realize bonds can lose money and do lose money periodically. And last year was certainly an extreme example of that when we saw interest rates, go up a historic 7 times. But in the end, as we take a look back on 2023, it certainly was a very strong year, and that's reflected in the participant balances, which is a great thing. On a year to date 2024, we've actually started off really strong as well. Through a couple days ago, anyway, the Standard & Poor's 500 index was up 6.5%. The EFI benchmark up 2.5%. So equities have started off strong again this year, with domestic equity continuing to outpace international equity. And I'll circle back to that comment as we talk more about your funds. The other thing we saw, and again, this really has a dramatic impact on your fund lineup, is we saw this incredible rotation from value to growth. So again, for committee members who have been around for a while, you'll recall in 2019 and 2020, we were really just talking about this incredible growth-oriented market. So large, mid, small cap growth really led the way for both of those years. Then in 2021, towards the end of 2021, as interest rates started to rise, we started to see this rotation to more of a value orientation. And really throughout 2022, while all asset classes were down, it was certainly value asset classes provided more downside protection. So we saw this really complete rotation away from growth. So all of those stocks that we talked about earlier, all of a sudden were out of favor. Growth was out of favor as a style, and really value was what we saw, kind of leading the market, providing more downside protection. Well, in 2023, we saw that rotation right back to growth. And you can see here at the bottom of the page, large cap growth leading the way, led by mid and then small, outperforming all of the value asset classes. So while everything was up for the year, which is great news, it was much more of a growth orientation. I think that that's an important concept, because as we start to look at your funds, and I want to emphasize all of your funds are in good shape, all of your funds really did well in 2023. But those types of market rotations, especially when they're relatively rapid like that, where we go from growth to value and back to growth again, they do tend to lead to periods, typically short-term periods of underperformance, really just stylistic headwinds. So, managers who really lean more value, all of a sudden when the markets shift to growth, you'll see a little bit of underperformance there. Similarly, when we rotated to value, we saw some of your growth-oriented funds that underperformed for a year and all of a sudden look great again as we've rotated back to value. So I'll clearly provide a lot more details of that when we get to your fund lineup. And then the final thing I wanted to talk about on this page was just the upper right-hand corner. We really continued throughout 2023 to be in an inverted yield curve environment where short-term rates were higher than long-term rates. And the interesting thing there is, if you think back a couple meetings ago, really a few meetings ago at this point, going into 2023, we went through a number of different market scenarios, potential market scenarios, and they ranged anything from, on one extreme, stagflation crisis, so going into a deep and extended recession, all the way into stagflation like we haven't seen to the 70s, to the most optimistic scenario being that we would get this quote unquote soft landing that everyone was looking for and avoid recession. And, CapTrust was kind of firmly in the camp, along with about 95% of other financial institutions, that we were going to be going into a recession in 2023. We thought that was the most likely scenario. We thought it would be mild and relatively short. But, one of the reasons for that is that if you go back and look at the last 7 recessions, going all the way back to the 70s, an inverted yield curve has always been one of those leading indicators. And then when you started to add in other factors, that certainly looked like the most likely scenario. We're happy to say that we were wrong. And it does, in fact, look like, we will be able to, or have even avoided a recession at this point. And that's certainly good. It's good for the overall economy. It's good for the participants in your plan. It's not, we are expecting, certainly volatility in the markets, But we do think when you look at some of the economic data, that avoiding a recession is now, a likely scenario. And this slide I did want to point out because this kind of reiterates what I talked about earlier relative to the S&P. So this breaks down the different sectors of the S&P. If you think about those names that I mentioned earlier, the Facebook, Apple, Amazon, Google, names like that, those basically fall into one of two categories: technology or communication services. And you can see here that those two sectors just did unbelievably well in 2023. One of the things that's really helped us avoid recession is that the United States economy is really a consumer-driven economy. So when consumers are doing well and consumers are spending, generally speaking, our economy does well. And you can see consumer discretionary had a good year in 2023 as well. Unfortunately, what we're also seeing with the consumer spending is that we are now at historically high credit card debt. We have never seen the level of credit card debt in this country that we're seeing now. That obviously is that credit card debt is at higher interest rates than what we've seen in the years past. And I think when you go back to Barry's comments about the surveys showing that loans are up and hardship distributions are up in retirement plans, I would say it's really directly related to some of that credit card debt as well, where people just don't want to carry that debt load at high interest rates, and they're looking to their retirement plans as a method to pay that off. So it's frustrating, but it's really the reality of what we're seeing out there. So on a forward-looking basis, this just goes through what we believe are headwinds and tailwinds. And I'll summarize things by saying that we're really cautiously optimistic about 2024. We think that it's going to be a volatile year, and that volatility is going to be the result of really a lot of uncertainty. One thing that Wall Street hates is uncertainty. And when you think about it, we're in an election year, so there's always uncertainty around that. There's certainly geopolitical events that are leading to market uncertainty as well. But more tangible things, when you look at our headwinds column again, we think consumers are going to increasingly be challenged, even though inflation numbers have come down dramatically, and that's certainly a positive thing. Unfortunately, a lot of different factors have led to much higher credit card balances. So that's going to be a challenge for consumers. The housing market continues to be a struggle, in terms of the inventory that's out there, the interest rates on mortgages, which are preventing a lot of people from downsizing. People who might at some point in their life want to downsize all of a sudden don't want to walk away from mortgages at 3% when mortgages are all of a sudden at 7%. So the housing market, we continue to have challenges. I know that firsthand as the father of a son who just bought a condo in the Portland area and saw what he had to go through just to try to get the financing and now to try to meet the the monthly mortgage rates. Election uncertainty I mentioned, and then investor optimism always creates risk. As investors, it's kind of this unique phenomenon where investors, as they start to get more optimistic, oftentimes that leads to periods of downturn in the market. But again, from a tailwind perspective, we really think there's a lot of good things going on, including the fact that we've been able to avoid recession, it looks like at this point. Wage growth, so consumers continue to be in a good position in terms of the wage growth over the last couple of years. Productivity has improved, including productivity around AI. I mean, it is amazing the impact that, potential impact that we're seeing on AI in the marketplace and the productivity in the marketplace. It's something that certainly CapTrust has fully embraced as well. And we think that, the ultimate impact on AI, while, there's certainly some negative components of that, I think overall it's certainly going to be positive. The one thing that I didn't talk about when we talked about consumer debt and credit card debt and mortgage rates is that, the other debt that no one wants to talk about this year in an election year is our national debt. If you look at the national debt as a percent to GDP, we're really at wartime levels. And that's something that certainly at some point someone's going to have to have the courage to deal with politically, because we certainly can't continue with the level of national debt as well. But overall, again, while there's certainly a lot of things that I think will lead to volatility over the course of the year, we do believe that 2024, we believe we're certainly cautiously optimistic that 2024 will be a good year for investors. So I'm going to move ahead to your plan specifically. And again, it looks like there's a little bit of a pause here with my slide movement, so I apologize. It should come into clarity here in just a second. But I think Barry addressed this a little bit at the start of the meeting, but we always like to just pause and take a look at the fund lineup at a macro level. And we continue to think that you have a really well-structured fund lineup. You have all the critical asset classes covered on both an active and a passive basis. So if you have investors that want to create just a low-cost index or passive portfolio, they can do that using the full suite of Vanguard funds. If you want access, or if investors want to be in high-quality, best-in-class active funds, we really believe you have that as well in your core fund lineup. And then you can see under QDIA, your default investment option is the Vanguard Target Date series, which we continue to believe is a best-in-class target date series as well. So again, we think you're doing everything right from an overall plan management perspective. To Barry's point, one thing that we really do hope for is that collective investment trust legislation eventually passes. It technically, you may recall, it technically did pass as part of the Secure Act. Unfortunately, like a lot of things in the Secure Act, it was kind of poorly written and it directly conflicted with securities regulations. So the result of that is basically there's a whole new piece of legislation out there now. It's a long title called something like the Fairness for Charitable Organizations and Educational Organizations Act that's been filed. And we're going to hope, as Barry said, is going to get voted on and approved. And that ultimately will lead to our ability to start recommending CITs or collective investment trusts. So taking what we believe is an already really good fund lineup, really low cost fund lineup, and actually, continuing to make it better. And at this page, you can see just a summary of the totals. I won't go through each line plan by plan, but you can see $1.8 billion in total plan assets. And then down below, we always include the legacy plan balance down here as well. That's when you used to be in a multiple vendor environment. You still have some money in those legacy contracts. Really, frankly, a remarkably low amount of money compared to what we see in a lot of other organizations. But the nice thing here is from a growth perspective. This was a quarter where we really saw plan growth. It was a year where we saw plan growth, and that's obviously a good thing. And then finally, before I get to the scorecard, I really like this slide because it does show where the money is invested at a very high level. You can see stable value continues to be your largest asset class. That's really the TIA traditional at about 30% of plan assets. Asset allocation would be your target date funds at about 17%. And then the balance is divided amongst a number of equity bond funds as well. So, really good diversification. I'd love to see more money going into the asset allocation or target date funds. I'm a huge fan of target date investing. And I think you have amongst the, certainly the best target date funds on the market in your plan as well. So I'm going to go through the next several slides really quickly. It really just goes through, again, a different way of looking at the assets in your plan. So I don't want to spend a lot of time on that. Again, I know that the slides are advancing pretty slowly, but as I pause and get to the next section, I just want to see, are there any questions at all on anything that I covered, either market related or high level plan related at this point? No questions? Okay. So the next thing I want to do is get to the scorecard, and I'm hoping we're going to get there very quickly. My apologies for the slow slide advancement here. Okay. So hopefully now you can see the scorecard and you can see it clearly. And you can see we do have a couple funds that are marked for review. In both instances, I will say that we really don't have any concerns about the funds or the managers, or frankly, even the performance of the funds. These funds that are where you see either the marked for review in the instance of the JP Morgan Equity Income or the Euro Pacific Growth Fund, really the result of the stylistic headwinds that I talked about earlier. no concerns about the management of the funds, the approach of the funds. Again, really, I think the market rotations led to short-term performance issues, which are largely explained, and I'll explain in more detail, largely explained by those stylistic headwinds. But just first, addressing the JP Morgan Equity Income Fund. JP Morgan Equity Income is really a deep value fund. You can see the 3 and 5 year performance is just slightly below the 50th percentile, and that's leading to an overall score of 76. One thing with the JP Morgan Equity Income Fund is that as a pure value fund, what we would expect this fund to do is perform better or provide more downside protection when markets are down, but it's going to lag when markets are up. And when you look at the performance of this fund, that's really exactly what we've seen. In 2022, this is a fund that closed out the year in the top 20th percentile. So it beat 80% of its peer group in 2022's down market. Then all of a sudden, markets rotated really pretty rapidly back to growth. So in 2023, this is a fund that ended up closing the year down in the 87th percentile. We saw similar dynamics in 2018 and 2019. So when markets were down in 2018, the fund showed good downside protection, but then lagged in 2019. There's really no issues with the fund or the managers at all. And in fact, the fund is performing exactly as we would expect when markets are performing the way that they are. Overall, the fund is scoring a 76. Back on a year-to-date basis for this year, it's back. It's certainly improving. It's back up in the 60th percentile on a peer relative basis. So anytime a fund is marked for review, we always want to keep a closer eye on it. But really, in this instance, not something that we're overly concerned about. The vast majority of time when funds are marked for review, they do come back into good standing over time. The one thing I did want to point out on this fund that we're certainly keeping a close eye on is that the lead manager retired. And that's something that obviously from our perspective, we always want to look at closely. We noted that in the fund management column. We're comfortable because that was part of a planned retirement and a very clear succession plan. But, when you start to see a manager depart, and then if that leads to periods of underperformance, that's certainly something that we're going to look at closely. But for this quarter, again, marked for review, but no change recommendation. We continue to really like the strategy and like the management of that fund. Harbor Capital Appreciation is really an interesting fund. It's actually in many ways, I think, the poster child for this market rotation. If you really want to understand this market rotation on fund performance, look no further than Harbor Capital Appreciation. This is a fund that in 2019's growth market was up about 60%. 2020, again, a growth-oriented market, this fund was up in the mid-30s. All of a sudden in 2022, markets started to rotate to value, started to rotate away from big tech. This fund operated down in the 79th percentile. And then last year, when we saw that complete rotation away from growth and away from those big tech funds, this fund all of a sudden was down 37%, and it was in the 83rd percentile. And that's really what's causing this 3-year number to be below the 50th percentile. Well, as you know, we've talked about this rotation back to growth and back to these mega tech stock names. Well, all of a sudden, if you look at 2023, this fund was actually up 54% in 2023, and it beat 92% of the peer group. So if you look at the top 10 holdings in this fund are kind of like the who's who of that magnificent 7. And the result of that is, as you would expect, an exceptional year in 2023. And so far, year to date, 2024, it's up 12.5% and beating 90% of the peer group. So again, even the underperformance, we're comfortable with, as long as it's explainable, based on what's going on in the market. So we actually would have expected this fund to underperform 2 years ago. It absolutely did. And we would have expected this fund to do really well in 2023, and it absolutely did that as well. So again, 3-year performance below the 50th percentile, but overall that fund is scoring an 87 and in good standing. And then finally, Euro-Pacific growth. The American funds, this is really one of our top conviction choices in the international space. It has been for a long, long time. American funds has as deep a team on their funds as there is in the industry. They manage their funds really through a series of teams, and each one of those teams is deep and experienced, and they do a great job. And the Euro-Pacific Growth Fund is certainly one of their flagship funds. It's been a great performer for a long, long time. But again, a couple things have impacted the short-term performance of this fund. One is those market rotations that we talked about earlier, which impacted international markets actually differently than domestic equity markets. And another thing is this is a fund that does have a higher percentage of exposure to emerging markets than a lot of its peers. It's a blend fund, but it's certainly a growth-leaning blend fund, and they can go up to 30% with emerging markets. And so that led to a period of underperformance a couple of years ago when emerging markets really struggled as an asset class. Again, overall, the fund is scoring a 78. If you look at the performance over the last 3 years, so year to date, it's right at the 50th percentile. Last year, it closed out just under the 50th percentile, and the year before that, it was 38th percentile. So again, no real concerns here. The long-term numbers look great. The management is, deep and experienced and stable, and all the things that we want with an active management team. And so, really, no concerns about Europac. So, 2 funds marked for review on this page, but again, we have a kind of a strong hold recommendation on both of those funds with no concerns. And then finally, both MFS Intrinsic Value, which is an international blend fund, but more value leaning, and then Victory Sycamore Small Cap Value, which is your small cap value fund. Very similar story there. The stylistic headwinds had a slight negative impact, but the funds are performing as we would expect. Victory, just again, as an example, it's a small cap value oriented fund. The fund in 2022 was top quartile, so provided decent downside protection, lagged in 2023 as markets shifted back to growth. And so far in 2024, it's back up in the top half. And again, both of those funds overall in good standing. So no concerns there. I want to pause again and see if there's any questions on the actively managed funds before I go to the index funds and the passively managed funds. Okay, in the target date space, you have the Vanguard series. Again, continues to be really one of our top choices in the target date space, certainly in the passive target date space. We love Vanguard. You can see scoring an 88. Their performance was what I would describe as mixed in 2023. So they underperformed a lot of their peers, but they outperformed their benchmark. It's really largely explained by 2 things in terms of that mixed performance. One is that Vanguard's glide path, and that is basically that percentage of equities versus fixed income, it is more conservative than a lot of their peers. And so the result is a more conservative glide path in a very, very productive market like we had in 2023 is going to tend to lag a little bit. And that's certainly something that we saw, very, very slight lagging performance. The other thing, though, is that Vanguard has a position of overweight international equity to domestic equity, specifically in that equity sleeve. So they've just had this thesis that goes back several years that there's more opportunities in international. It really goes all the way back to 2019 and 2020, where they felt like the domestic equity market was overvalued and there were more values, more opportunities internationally. So they have a slight overweight position international, and that has been a detractor as well. But again, overall, the funds are scoring 88. They really, continue to do well. So a little bit of lagging performance, peer relative, but still doing very well benchmark relative. And you look at the long-term performance of the Vanguard Index Series, it frankly stacks up against any target date series on the market. So no concerns there. And then we just give an overall score of in good standing. The TIA Traditional, I think for people who are in that are seeing just the incredible interest rates that you're getting on that TIA Traditional these days. And then the full suite of index funds are also all in good standing as well. So I'm sorry. And then finally, I should point out the TIA Real Estate and CREF Stock. those are two unique investment choices that are kind of difficult to score relative to peers. TIA is really more of a direct investor in real estate, unlike traditional REIT funds. And then CREF stock is really it's a total stock account fund in many ways, where you're getting large, mid, small, even some international exposure. So with these two, we really just give you a qualitative score rather than try to benchmark them on a peer relative basis. We really look at them just overall and continue to feel good about both of those choices. So, you know, your overall plan score remains really high with a score of 94. Even though you have a couple funds that are marked for review, you can see your overall plan score is really good. And I think more importantly, when you look at, you know, the scores, what you're going to find, I think, is that we're going to start seeing a lot of these scores on the upward swing. So I really do feel confident that JP Morgan Equity Income and American Funds Euro Pacific Growth, especially Euro Pacific Growth, we're likely to see higher scores. I think Europac might end up back in good standing even as soon as next quarter. But you can see, again, what I like about this page is it shows where these funds have been. And you can see, for example, JP Morgan Equity Income, really consistently high scoring fund. And then that kind of drop, if you will, into that marked for review category is a result of what I think has been a very unique market over the last couple of years, with extreme swings from growth to value, and then back to growth again. Similarly, Euro Pacific Growth was impacted by those swings as well. So again, I'll stop there. I'm certainly happy to go into a lot more detail on any of the individual holdings if you'd like me to, and certainly, you know, happy to take questions as well.
Mike, I have a quick question. This is Matt Scaves. I don't know if you can hear me or not. I'm on my phone. I apologize.
Yep, I can hear you fine. Thank you.
Okay, good. Maybe I just haven't seen it in the investment menu, but do you think there's any value in offering passive funds that might be growth or value, so that if an investor wants to do their own allocation, they don't have to be forced into an active fund to get at that?
Yeah, I mean, so what we do, if you think about the fund lineup, we want to offer an active fund in each of the categories: large, mid, small cap, both growth and value, and that's certainly what we have. So if you look at large cap growth, just as an example, we have JP Morgan, which is a value oriented large cap fund. We have Harbor Capital Appreciation, which is a growth oriented fund, and then in between, in a blend category, which is a mix of growth and value, we offer, for example, the Vanguard Institutional Index, which is an S&P 500 index. We have the Vanguard, Extended Market Index, which gives you mid cap, small cap exposure, and then the International Index. So we think that the suite of index funds that we're offering gives investors ample opportunity to diversify across fixed income, large cap, mid cap, small cap, and international on a pure passive basis. I think so, and correct me if I'm wrong, but I think what you're saying is that should we be offering a large cap value index, large cap growth index, and kind of break it down even more granular? And that we tend not to do, because we think at that point it leads to so many funds that potentially leads to confusion with participants. And so we think that there's a fine line between the right number of funds and too many funds. And I'd like to think that we're really, you know, kind of right at that sweet spot in the main plan. But to your point, people certainly do have the opportunity to invest in low cost passive funds through the core fund lineup.
Thank you.
Yeah, great question. Other questions for me?
One comment I just wanted to make sure that the committee was aware of, the trustees were aware of, is you may hear some information. Nuveen was an organization that TIA purchased a number of years ago. They are rebranding a lot of their funds into the Nuveen brand. And so you might get some information in terms of what was formerly TIA CREF is now Nuveen. It doesn't change any of the investment objectives of the funds, but there might be some rebranding you might see over the course of the next. I think they started communicating here early February. So just informational.
Great point. Thanks, Barry. Great. Well, it was great seeing everyone. If there's no other questions, and we'll see you again in May, and we'll certainly be talking to Tracy and Trustee Martin about some of the other issues as well. But thanks, everyone.
Thank you all.
Trustee Martin, you're on mute.
Phone thing's quite the trick. I have a double mute button, one on the phone, one on the computer. So thank you, Mike, for that comprehensive review of the investment lineup. And thank you, Barry, for going over tab 2 with us. And we'll move forward. If we have no questions on what we've reviewed so far, I see Kelly Regan from NEPC is on the phone, and I will pass the meeting over to Kelly to discuss the capital markets review and the quarterly performance of our 3 portfolios. So welcome, Kelly. You have the floor.
Thank you. Thank you, Trustee Martin, and good morning, everyone. It's good to be with you today. If you just noticed too, one of my colleagues, Matt Landon, just joined the meeting as well. Matt will be joining me on the account. And so you'll be seeing both myself and Matt going forward. Matt's been with NEPC for 5 years and focuses primarily on endowments and foundations and some of our high net worth clients. So thanks, Matt, for joining. It's good to see you.
Thanks, Kelly, and nice to meet everyone.
Great. Well, today we have 2 items to review. The first is a performance review, and then the second is an asset allocation update. Just note that there's no recommendations being made today, so this is just for your information only. So why don't I share my screen with all of you? Okay, can everyone see that? Just get a thumbs up. And had not, yep, got it. Great. So before I get into a market overview, and I'm going to be short on my market overview because I did just listen to CapTrust, and they said a lot of the things that I would say. But before I do that, I want to just stop on this page and talk about our annual investment conference. Kelly and Tracy have attended in the past, and all of you are invited to come. It's going to be in September this year, September 9th and 10th in Boston. So there's some details here on this page and in the packet, and we'll be sending out more information as the year progresses. But just wanted to let everyone know in case you wanted to mark it on your calendars, or if you happen to be in Boston around this time, we would love to have any of you join us. It's a great 2 days of speakers talking about the markets. It's not a sales conference. We're not trying to sell anyone anything, and we don't have investment managers there pushing any other product. It's simply informational and to allow all of our clients to get together and talk about issues they're facing and just connect with others in the industry. So in terms of the market outlook, what I'm going to do is I'm going to stop here on page 112. So CapTrust did a nice job of recapping what happened in 2023. As you know, markets were very strong. You'll see in a moment that the performance of your portfolios were very strong on an absolute basis. And, you know, they did briefly mention, but February has been a continuation. We have the S&P 500 up 7%. China is bouncing back in February. China, as of last Friday, is up 10%. And we'll talk a little bit about why China is important to some of the managers in your program. And then fixed income rates, they fell in the fourth quarter, but they have started to rise here year to date in 2024. So you'll see some fixed income results being negative year to date through last Friday once we deliver the February report. But focusing going forward, CapTrust had some of their themes, their headwinds and tailwinds that they're looking at. We have ours as well. We call them our 2024 market themes, and we think that these 5 themes listed on the page are going to have some impact on the market. And if these themes play out, it could be positive for market, or it could also be volatile for the market. And just, you know, counseling clients to have a diversified portfolio, have a liquid portfolio to take advantage of any opportunities that could arise out of these themes. And I'm happy to say that the University of Maine system, all 3 portfolios are very liquid. So if we do see some opportunities, we can certainly discuss those with you and potentially capitalize on them. But just to start with the first theme here is the cost of capital. As we know, the Federal Reserve has raised interest rates pretty high, above 5%. And the economy is really not attuned to operating in this long-term interest rate environment of 4% or higher. We had been in such a long period with very low interest rates, and this impacts companies that are looking to access capital and may need to refinance in 2024. So that is a big focus. And this specifically may impact small cap companies more than large cap companies. And we can kind of see that when we look at the performance of the Russell 2000, which is a small cap index, as it is negative year to date because interest rates have risen. So they're more impacted by these higher rates. The large cap companies, not so much impacted. Most of the S&P 500 companies have termed out their debt into 2030. So these higher interest rates is not as much of a burden for the larger cap companies. And we can kind of see that in part by the performance of the S&P 500. Certainly there's a story of artificial intelligence and the Magnificent Seven, but also not being impacted by higher rates. The one positive of these higher rates is it's a benefit to many consumers who can save in money market funds that are earning 5% annually. And that really, flows into the economy. If they're able to make more money on their investments and certainly the cash investments, that can, help them spend, whether it's vacations, whether it's the groceries, whether it's putting that money back into the economy. So there is a positive of this higher cost of capital. In terms of the Magnificent Seven, we've talked about it. I know you just heard about it. We have 7 companies that make up almost 30% of the S&P 500 index. They have sky-high earnings growth expectations that they need to meet to justify their current multiples and the current valuations. I believe it's around 30% earnings growth expectations that they need to meet to justify these valuations that they're sitting at. These 7 companies, when they get to this large size, it becomes harder and harder to meet those expectations. And if we look at past history, we can see that, some of these things tend to start fading. So if we look back into the 1990s .com bubble, similar things happen there and these stocks fade. So again, the other part of it is artificial intelligence, which is the 4th theme on this page. That can continue to push these stocks higher and other stocks higher if they are able to tap into artificial intelligence and improve productivity. So certainly can have more room to run here, but it is one of the areas that we're a little bit concerned on. And we're talking to clients about diversifying away from the S&P 500 a little bit. And for the managed investment pool, where you have the largest allocation to the S&P 500, we have been underweighting that a little bit through rebalancing efforts when those arise. And while I have no recommendations today around asset allocation, one of the projects that Matt and I are working on that we'll present to you at the next meeting is looking at the equity portfolio for the managed investment pool and looking at ways to, one, reduce the fossil fuel exposure. And we have some interesting ideas there around global equity, managers that can invest in US stocks, international stocks, and emerging stocks. And that could potentially reduce the dedicated exposure to the S&P 500 a little bit. So again, more to come, but we are going to be coming to the next meeting with a complete equity portfolio review to, one, help diversify the portfolio, improve the manager lineup, and we'll talk about a couple managers that have been underperforming when we get to the performance section. And then 3, look at additional ways to improve the fossil fuel exposure. The 2 other themes on this page is the fiscal debt for the U.S. Barry and Mike mentioned this, but our deficits here in the U.S. are very high. And if we continue on this cycle, it could require higher interest rates. So again, we're in a high interest rate environment. It'll be interesting to see what comes out of this. Not only the U.S. is experiencing this, but globally countries are experiencing this. So there are going to be winners and losers based on their each country's fiscal debt. You know, I think the one thing to say is that the US really doesn't have much of a competitor for the global reserve currency status as it stands today. That could change in the future. However, you know, that leads us to think that the US may be in a better position compared to other countries based on this. But overall, we need to do something here in the US, whether it's increase our revenues through taxes, reduce spending, or have higher growth in order to maintain a healthy debt to GDP ratio. So again, another area that we're watching. And then the last item on this page is geopolitics. You know, we've had events occur. This seems they occur every year. Sometimes they matter. Sometimes they matter a lot. Sometimes they matter less than we think. However, tail risk can be created with any of these events. But typically what we see is they're short-lived. And so if we do see any events in 2024 and beyond, again, our message to clients is, again, stay diversified, have the liquidity, and if these events do cause volatility in the markets, we can look at ways to take advantage of that through opportunistic investments. Another area regarding geopolitics is, you know, sometimes these events can strain supply chains and specifically the energy sector. So if any of these events do occur, it'll be interesting how that impacts inflation, which we're trying to manage here as well as globally. And then lastly, elections. That's a big topic. It's a big topic here in the US in 2024. But just want to remind everyone that about 50% of the world's population will be voting in 2024. So certainly, you know, if we do have changing leadership in countries, that can impact foreign and domestic policy as well as trade and currency impacts as well. So this is a pretty big theme here because there's a lot of components to it that can cause volatility in the markets. I've mentioned this before, and it's not on the page here, but based on all this, our portfolio positioning views, they haven't changed from the last time we spoke. We still favor value equities, specifically large cap, or we favor global equity in order to reduce large cap equity. So again, as I mentioned, we're going to be looking at global equity as a way to reduce large cap for the managed investment pool at the next meeting. Specifically, one of the reasons why is because within global equities, and you have Walter Scott today, we do find that those types of managers have more potential for active management outperformance. We also are favorable on holding a little bit higher levels of cash because of the higher yields. And then also we're favorable on tips because of the increase in real rates and the high inflation. And tips are an investment in the managed investment pool and the pension plan. So overall, we believe that the three portfolios are taking advantage of our positioning views. And within the one area, we're going to be looking at that next at the next meeting. So I'll stop there and just see if there's any questions on our outlook for 2024.
Any questions from anybody in the committee?
Okay, hearing none, I am going to move forward into the performance review here on page 114 and starting with the operating fund. So just at a high level here, the operating fund had about 271 million in assets at the end of 2023. And this was about an $8 million decrease from the third quarter. When you look at the asset allocation across the three pools, the liquidity pool, the income pool, and the total return pool, those pools are within policy ranges. On a positive note, I'll let you know that at the end of January, the operating pool assets increased by 70 million to 345 million. And this is due to the positive cash inflow that we typically see around the January timeframe, but also because in the month of January, performance was positive about 50 basis points. In terms of the fourth quarter performance in the top right here, you can see that it was a very strong quarter for the operating fund, which is 30% invested in cash. It was up 4% during the fourth quarter alone, and managers overall outperformed if you compare that 4% to the 3.9% for the allocation index. Similarly, very positive 2023 calendar year. If you can look at the 1-year number, up almost 8%, well outpacing the 4% return goal of this portfolio. However, managers did underperform a little bit if you compare that to the allocation index over the 2023 calendar year time period. And this underperformance came from cash holdings underperforming the cash benchmark slightly, and that's a third of the portfolio, as well as some defensive positions like Newton, which is one of your global asset allocation managers, and Lighthouse, which is an equity hedge fund manager, as these managers hold more defensive positions that do well in struggling markets. And as you know, 2023 was a good market environment. If we move on to the pension plan, you can see in the top left here, about 18.7 million in assets. So this is the smaller of the 3 portfolios. This is a $300,000 increase from the last time we spoke. And when we look at asset allocation, the asset allocation is slightly out of policy ranges with regards to U.S. tips. If you remember, in the middle of 2023, we went through an asset allocation study where we reduced, and the committee approved, reducing real estate and increasing tips, amongst other things. In real estate right now, most managers are taking a little bit longer to send back the redemption request given the real estate market. So we're a little bit underweight tips at the end of December, but important to note is we have done a little bit of rebalancing, and we now have tips within policy ranges now in 2024 with recent rebalancing. So once you see this at the next quarterly meeting, tips will be within policy ranges. In terms of performance, very positive quarter performance here, a little bit more equities exposure in this fund compared to the operating fund. So you can see the quarter results about 7%, and managers outperforming by 40 basis points during the quarter. So some strong active management there. However, over the 1 year, you can see while it was positive, up almost 10% on the calendar year 2023, the 1 year time frame, well outpacing the 6.25% return goal, managers did underperform. And similar comments here with regards to defensive positioning, so Newton and Lighthouse. Moving on to the managed investment pool, we have assets at 377 million, which is 27 million increase in the quarter alone. The asset allocations in line with the policy targets and within policy ranges. And if we look at this value in January, it's increased up to about 379 million. So a couple $1 million increase in the month of January, given some positive returns of 40 basis points. In terms of the quarterly performance here, you can see that the portfolio is up 8%. So again, this is the most aggressive of the 3 portfolios. So really took advantage of the equity market rally in the 4th quarter. Managers underperformed a little bit, and some select equity managers that typically do not outperform in strong and quick markets were the reason why for that 40 basis points underperformance. However, most of these managers that underperformed during the quarter have outperformed in the softer January markets. And I am hopefully positive that these managers will also outperform in February, given some of the managers that underperformed in the quarter underperformed due to China positions, and China has rallied in the month of February. For the 1 year time period, you can see the portfolio is up almost 15%, well outpacing the return goal of 7.25%. And managers underperform, similar to some of my comments earlier, given the defensive positioning. This is one portfolio that we rank against peers. So peers of the endowment and foundation universe with similar size assets between 100 and 500 million. And you can see those rankings at the bottom of the right-hand chart on the top right. You can see that it ranks above around the 3rd percentile, or the top third of the universe, ranking 38 over the quarter and 32 over the 1 year time period. So again, remember, 1 is the best ranking, 100 is the worst. And in periods when equity markets and public equity markets rally, this portfolio will rank well because it does hold more public equities compared to this peer group. The peer group holds a little bit more in private equities. And over the longer term, you can see the rankings are below median. And that is partially due to over the longer term, private equity typically outperforms public equity and not holding private equity where your peers do. That has led to some poorer rankings. In terms of the managed investment pool and the operating fund, there was one manager announcements during the quarter, and NEPC has placed this manager on watch, and that manager is Silchester, which is one of your fossil fuel-free international equity managers. I think I gave everyone a heads up about this at the last meeting, but just as a reminder, one of the founding partners did pass away due to an illness. That illness was disclosed to NEPC in 2022. And this individual remained involved in the firm until about mid-September and then unfortunately passed away in October. So NEPC has just placed Silchester on watch as we want to monitor the firm and the strategy as they need to manage through transitioning this gentleman's responsibilities to other members at Silchester. Not very concerned about it, but again, one of the founding members passing away, we want to just watch and make sure that everything transitions appropriately. If I move on to manager performance here, just starting with the managed investment pool performance, I'm going to start with the total domestic small cap line here in the top. You can see some very positive numbers across the board. Long-term numbers are well above the benchmark and rank very well versus an industry of other small cap peers. During the quarter, a little bit of underperformance from both managers. But overall, if you look at the ranking of these two managers combined, it ranked in the 26th or the top quartile of the universe. So the combination of Westfield, which is a little bit more growth, and DFA, which is a little bit more value, has outperformed the general small cap universe. And you can see that overall time period. So it's one of the bright spots of the portfolio. Walter Scott also had a good quarter. And also ranks well during the quarter in the 1 and 3 year time period versus peers. Some of the underperformance from Walter Scott over the 1 year and 3 year time period is due to this is a growth manager. And if you remember in 2022, growth did underperform value. So that is impacting some of the longer term returns versus the benchmark, which is a core benchmark. But generally, when we look at the manager, they are ranking very well in a group of global equity funds and have no concerns there. Silchester, moving down into the international equity space, again, is that fossil fuel-free manager. Positive absolute performance for the quarter, but did underperform the MSCI EAFE of 10% during the quarter. This is a manager that does not keep up in market rallies or very fast market rallies. So their performance is not unexpected during the quarter. And what you can see from them over the long term, the 1 year time period, they have outperformed. So again, over a full 1 year where there are some quarters where markets struggled and then some quarters where markets were starting to go up, overall, generally, they tend to outperform over the longer term. It's just these 1 quarter anomalies that you may see some underperformance, ranking very strong over the last 1 year. J.O. Hambro is another manager, similar to my comments with Walter Scott, good quarter here, ranking well above the benchmark. 1 year numbers coming back here. You can just see the 3 year number, which takes into account the 2022 underperformance that J.O. Hambro had, given their growth bias. But again, they are starting to bounce back, specifically in 2023. Now focusing in on Axiom, Aberdeen, and Mondrian, there's a lot of themes that play through with these 3 managers. So you can see that these 3 managers for the quarter underperformed. The Axiom performance has been more disappointing over all time periods shown here. I just want the committee to know that we just re-underwrote the strategy at NEPC, and this manager did again get a 1 rating from NEPC's research team. So even though recent performance has underperformed, we still think highly of the team, the strategy, and the process. Their largest detractor and some of the reasons for this underperformance is because they are significantly overweight consumer stocks that are linked to China. And China has been struggling given their slower economic recovery. Within Aberdeen and Mondrian here, again, both managers underperformed. Aberdeen for stock selection in China. The 1-year number underperformed because they were underweight energy, and over the 1-year time period, energy and information technology were both up 30%, as well as the China exposure hurt over the 1 year. And then Mondrian, difficult quarter on a relative basis, similar comments that I made with Silchester, where they don't perform very well in strong up markets, but you can see their longer term results are very strong. And having the exposure to Mondrian, or the emerging market small cap exposure Mondrian brings to you, has been beneficial to the portfolio. As you can see, their returns are much higher than Aberdeen. The comments that I made earlier about looking at the equity portfolio, one of the managers that is going to be included in that review to see if there's a better replacement or where their fit is in the portfolio will be for Aberdeen, just because of the long-term underperformance that we're seeing from them. Moving on to fixed income, I'm just going to focus on the top line here on this page, which aggregates the returns of all the underlying managers. For the quarter, you can see fixed income was up 5.1%, underperforming the Barclays aggregate, which is the broad benchmark. Most of this underperformance came from Bain, which is your bank loan manager. Bank loans tend to do in rising interest rate environments, and we saw falling interest rates. So that did have a little bit of drag on the total fixed income portfolio over the quarter. However, if you look at all the other time periods here for the total fixed income line in the light blue, you can see the fixed income portfolio has outperformed the Barclays aggregate, and the diversification in the fixed income pool across credit, treasuries, bank loans, diversified fixed income through BlackRock has really added and benefited the portfolio. I mentioned earlier some of the reasons that all three portfolios underperformed the overall benchmarks over the 1-year time period were partly due to Newton and Lighthouse. And you can see those two managers here on this page. And focusing on the 1-year column, you can see that both managers underperformed their benchmarks, which were up about 10%. So again, these two managers are designed to help protect portfolios when we have volatile and struggling market environments. Specifically, Newton, they have hedging positions in their portfolio that typically add value when markets are not doing too well. And then Lighthouse is a manager that typically invests in equity-like instruments, but in more of a hedged nature. So again, when markets are up, 10+%, they typically do underperform. If we looked at some of these numbers back in 2022, you would have seen that both of these managers did very well in that struggling market. Moving on to the pension fund, most of the managers here are the same as the managed investment pool. There's a couple differences. The first one is Baird, which is in the middle of the page here. It's a manager, a core fixed income manager that manages the Barclays aggregate. You can see very solid performance for this manager over all time periods versus the benchmark and versus other core fixed income funds. If you look at the rankings, being in the top quartile. So no concerns with Baird, very strong manager that has a good history of good credit selection within fixed income markets. And then Principal down here at the bottom, again, is the real estate manager that has 8% of the portfolio, and we're trying to work that down to 3%. We have redemption requests in. Even though the performance in real estate markets is negative, as you can see here on the page, they are still able to outperform on a relative basis, albeit being the returns, the absolute returns are negative. And then moving on to the operating fund, again, a lot of similarities and overlap with some of these managers. Some of the differences are income research and management, which is the first manager in the income pool. Again, this manager has a great track record of outperforming its benchmark ranking very well versus peers, very high quality manager in the fixed income space. And this particular mandate is for the short term fixed income part of the market. And then in the total return pool composite, we do have another global asset allocation manager, PIMCO All Asset, which has some nice returns over the 1 year time period. You can see up, over 8% outperforming its benchmark. Longer term, you can see that they're outperforming their benchmark and ranking at median or above median versus peers. And even the more recent quarter, outperforming the benchmark, just underperforming peers, as this manager tends to not really have too much exposure to global equities. I think, historically their exposure is around 10 to 15% or so. So when you're benchmarking them in a universe of other global asset allocation managers that may have different exposures to equities, you can see sometimes that the rankings will fall short, but overall outperforming the benchmark. So I'll stop there and just see if there's any questions on any of the comments that I made around markets, around the overall portfolio performance, or any of the manager comments that I made, or any questions about the project that Matt and I are working on for the next meeting. Okay. Hearing none, I'm going to move forward to the asset allocation review. So give me a moment as I scroll through. There's a lot of supplemental materials that I'm scrolling through right now. Just has a lot of information on risk statistics, manager information, whole bunch of information if anyone's interested in reading more about the portfolios. As you can see, it's a very large deck. Sorry about this. All right. So here we go. The asset allocation review. All right. So just to start, we update our capital market assumptions on a quarterly basis. So we have our assumptions based on December 31st, 2023, and that's what we've used for this analysis. When we look at our capital market assumptions, the valuation expansion that we've seen in equities has reduced some of our assumptions for equities compared to where they were last year. And then within the recent quarter, the fourth quarter, with the interest rates falling, that has reduced some of our fixed income long-term assumptions as well. When we think about the markets, up until recently, the market was anticipating that we would see the Federal Reserve cut rates. I think it was anticipating about, 5 to 6 cuts before we started this year. And that has come down significantly with the inflation prints that we've seen and the good growth that we've seen here in the US. And you can see in the fourth bullet point here, prior to that happening, we did believe that we would be in a higher interest rate environment and inflation would be a little bit stickier than what the market was predicting. And I also talked about one of the areas that we're talking to clients about in terms of asset allocation review is adding tips. Now that is something that the managed investment pool and the pension fund have today. So again, no recommendations to make regarding that. And then overall, I think what you'll see in terms of our return expectations is that given the higher yields in fixed income and kind of the equity valuations, you can income than you can in large cap equity. So that risk premium has been reduced over the long term. That being said, we don't want clients to completely shift out of equities into fixed income based on this. Partly because we do think that the next couple years for equities could be relatively strong years. So again, these are 10-year horizons, and we don't want to make drastic strategic moves based on kind of what is happening in the current market environment. Here are some of those return expectations that I was just mentioning. You can see large cap equity over the next 10 years. 4.4%. So again, this is that average over the next 10 years. So we think these next couple of years could possibly be positive for large cap equity, but baked into our assumptions is the potential for a decline in large cap equity, evening out to 4.4%. You can see that Treasury bonds US aggregate kind of yield, 4.2 to 4.6%. So this goes back to my comments is we don't want to just completely get out of large cap equities and shift into fixed income just because of the results showing on this page. And do want to maintain exposure into, broader equities. Within equities, you can see emerging market equity is the one area that our assumptions are projecting to be better than US or international developed equities. And again, you have exposure to emerging market equities at a weight that we think is appropriate. So just a couple pages we put in here is just our views on public market equity and the exposures that we're recommending to clients across US, international developed or non-US, and emerging market equities. So overall, we like to have our equity allocation about 60% to US equities, 25% to international, and 15% to emerging. And if you remember when we reviewed asset allocation last year, we reweighted the equity portfolios to be more in line with these strategic views. Also, within each of these regions, we do like to have both large cap exposure and small cap exposure, which you have in the managed investment pool. And we like the small cap exposure to be about 20% of the region's weight. So for example, here you can see for large cap US equities, a weight of 51, and then a 20% weight to mid cap, which would be about 9% of that 60% target. And again, all this has been reflected in your asset allocation for the managed investment pool when we did the asset allocation review last year. We also put in a page on fixed income. We think about fixed income strategic targets in three ways. One, having an allocation to what we call safe haven, which is cash and treasuries. And for high net worth clients, that would be municipal bonds. We think about it as the second area being high quality, which would include US TIPS and US corporate bonds. And I would say that your Barclays aggregate managers would also fit in this space, because even though the Barclays aggregate is invested in credit, treasuries, and mortgage-backed securities, those types of managers tend to be more overweight to corporate bonds and more of a corporate type bond manager. And then the third area is what we call return seeking. So this includes high yield. This includes bank loans. This includes managers like BlackRock that can flexibly invest across high yield bank loans, emerging market debt, and other types of fixed income return seeking areas. And when you see your portfolio specifically for the managed investment pool and the pension fund, these three areas are being captured. And we did add the safe haven treasury exposure the last time we reviewed asset allocation. So moving on to the MIP here on page 207, we've just listed out the current policy targets for you. When you look at the bottom of this table here, you can see if we apply all those capital market expectations to each one of these asset classes, overall over the next 10 years, we're expecting a 5.7% return, a little bit higher return over the next 30 years as markets normalize to about 6.9%. In the current policy target, like the return assumption that we're trying to target for the managed investment pool is 7.25%. And so what you can see is if we look at the median 30-year result of 6.9 and also a 1 standard deviation, so taking into account some volatility, the 68th percentile, that would be 8%. So a return between 6.9 and 8% we think is reasonable, and the 7.25% return falls right in line there. So again, we're not making any recommendations to change asset allocation based on this. For the operating fund, you can see that this is what I would call a cash plus portfolio. So we invest at liquidity pool, which is all cash and money market type investments, the income pool, which is all fixed income like investments, and then the total return pool, which is, I would call it an equity light type of investment pool. You can see the expected return over the next 10 years for this is 5.1%. This is pretty high for a cash pool based on where cash rates are and where fixed income yields are. And over the 30 years, again, still 5.1%. And if we add a little bit of volatility, potential to be 5.4%. The targeted return for this portfolio is 4%. And so you can certainly see that the range of 5.1 to 5.4 is well above what we're trying to target for the operating fund. So again, not making any recommendations here. What's interesting about this pool is if you look at the expected return over the 10 years of 5.1 and the standard deviation or the volatility of those returns of 3.9%, it's highly unlikely that if we have a 1 standard deviation event that this pool would lose money if you just do a simple math of 5.1 minus 3.9. It's a very conservative allocation. And then within the pension fund, the return goal here is 6.25. If you look at the bottom of this chart here, you can see over the next 30 years, we're expecting anywhere between 6.4 and 7.1% returns out of this pool over the long term, well above the 6.25 return target. So again, not making any recommendations to change the asset allocation here. And from our perspective, just wanted to show this to the committee and just reconfirm that the asset allocations are in line with your expectations and what we feel is appropriate for your goals and objectives. So I'll stop there and just see if there's any questions from the committee on asset allocation.
Kelly, it's David McMahon. Looking at the pension fund asset allocation, what's our estimate of the life of this pension fund as there are no new people joining? So are we in fact looking at 30 years when the fund's not going to be around in 30 years? Have we looked at that angle?
Sure. So what I'll use in terms of duration of this liability is relatively short because of the closed nature of this fund. I believe there's only 1 or 2 active employees that are still in the pension fund. So we're looking at a full fund full of retirees and terminated invested employees. So the life is relatively short. However, there are long tails. So, you know, the life of this fund could possibly go out 30 years, but it is the estimated benefit payments will just go down over each year because of the closed nature of this fund. In terms of the benefit payments for this fund are about, call it $300,000 monthly. And the return that we can generate in the pension fund in good markets can sometimes cover that, but it is hard to cover in terms of net investment income to cover those outflows. So the value of the overall pension fund has been declining given the high benefit payments that are going out relative to the size of the fund. However, there have been contributions into the fund because of the funded status, which is, you know, below 80%. So again, you know, that is enough to make up a couple months of benefit payments, but not to make up, you know, a full year of benefit payments going out of the fund. So one of the reasons why the pension fund asset allocation is a little bit more conservative is just trying to protect from any downside event that could eat away at the asset value of this fund, given the high nature of liquidity coming out of this fund for benefit payments. Thanks for the question, David. Hopefully that answered it. Is there any follow-up to that? Okay. Any other questions from the group? Okay. Well, thank you, everyone. It was great to be with you.
Thanks, Kelly, for that comprehensive review of the capital markets, quarterly performance, and the asset allocation review. Very informative. Appreciate your guidance.
Anytime. I look forward to our next meeting where we'll have some interesting recommendations for all of you to consider.
Excellent. And that brings us to the end of our meeting. I'll you guys all best wishes to enjoy the tropical weather. Stay dry. And any other questions in regards to what we covered here in the meeting? Hearing none. Have a nice rest of the day, and I look forward to seeing you soon.
Thanks, everyone.
Take care.
Bye.
Bye.